Most people think traditional versus Roth is this huge, complicated debate, but it really comes down to one simple question. Do you want your tax break now or later? Because both accounts are retirement accounts. Both can hold the same investments. Both can grow over time. The big difference is the timing of taxes. A traditional IRA is usually taxed later. A Roth IRA is usually taxed now. And once you understand that timing, the rest of the rules start to click. Quick note before we start. This video is for educational and entertainment purposes only. I'm not a financial advisor, CPA, or attorney, and this is not financial, tax, or legal advice. Rules change, your situation is personal, and state taxes can change the math. All right, let's build this around the most common questions people actually ask. So first, what's the real difference between a traditional IRA and a Roth IRA? Here's the cleanest way to think about it. With a traditional IRA, you may get a tax deduction today, your money grows tax deferred, and then withdrawals in retirement are generally taxed as ordinary income. With a Roth IRA, you don't get a deduction today, your money grows tax-free, and qualified withdrawals in retirement are generally tax-free. So, a traditional IRA is like getting a coupon at the register today and paying taxes later when you take the money out. A Roth is like paying full price today, but getting the never pay tax again receipt for the future, if you follow the rules. Next question. Can you contribute to both in the same year? Yes. You can have both types of IRAs, but the annual contribution limit is shared across them. So you don't get a separate limit for each account. You're splitting one limit across both if you choose to do both. For 2026, that annual IRA limit is $7,500, or $8,600 if you're age 50 or older, and you generally need earned income to contribute, because you can't contribute more than your taxable compensation for the year. Now the next one, who can contribute and what are the income limits? This is where a lot of people make their first big mistake. Traditional IRA. There's no income limit to contribute. Anyone with earned income can generally contribute, but whether you can deduct that contribution is a separate question. Roth IRA income matters a lot. At higher incomes, your ability to contribute is reduced and eventually eliminated based on your modified adjusted gross income. For 2026, if you're single or head of household, the Roth Phaseout range is $153,000 to $168,000. If you're married filing jointly, it's $242,000 to $252,000. Married filing separately is basically a trap range because it's $0 to $10,000. So if you're over those limits, you may not be able to contribute directly to a Roth at all, which leads right into the next question. How does the traditional IRA deduction actually work? A lot of people assume traditional equals deductible. Not always. If you or your spouse are covered by a workplace retirement plan like a 401k, the traditional IRA deduction can phase out at higher incomes. For 2026, if you're covered at work and filing single or head of household, the deduction phase-out range is $81,000 to $91,000. If you're married filing jointly and the spouse making the IRA contribution is covered at work, the phase-out range is $129,000 to $149,000. And if you're not covered at work but your spouse is, and you're married filing jointly, the phase-out range is $242,000 to $252,000. Meaning, yes, you can still contribute, but you might not get the deduction. And that leads to an underrated concept: the non-deductible traditional IRA. That's when you contribute after-tax dollars to a traditional IRA, usually because you're over the deduction limits, but you still want the account for some reason. And if you do that, you must track your after-tax basis properly, or you can accidentally get taxed twice on the same dollars later, Which brings up another question people ask all the time. What is Form 8606 and why do people keep warning you about it? Form 8606 is basically the paper trail for after-tax money inside an IRA. If you make non-deductible traditional IRA contributions or you do certain Roth conversions, this form can matter a lot. Because without it, you're relying on memory years later to prove which dollars were already taxed. And that's not a game you want to play. Okay, so which one is better? Here's the honest answer. Neither is always better. The right answer depends on what tax rate you're paying today, what tax rate you expect later, and how much flexibility you want in retirement. If you're in a lower tax bracket today and you expect your income to rise over time, a Roth can be powerful. You lock in taxes at a lower rate and future you get tax-free withdrawals. If you're in a high tax bracket today and you expect lower taxable income later, a traditional IRA can be powerful because that deduction can save meaningful tax now. But here's the catch. No one knows the future perfectly. Tax laws change, your career changes, your retirement plans change. So one of the smartest, most practical answers for many households is tax diversification. Meaning you have some money that will be taxed later and some money that won't. Because then, in retirement, you can mix and match withdrawals and potentially control your tax bracket more intentionally. Now, what if you need the money before retirement? This is where the Roth gets misunderstood in both directions. People either think, I can pull money out anytime, so it's basically a savings account, or they think, I can't touch it at all until retirement. The truth is in the details. With a Roth IRA, your contributions, the dollars you put in, can generally be withdrawn tax and penalty-free at any time. But earnings are different. Earnings have rules. There's a 5-year rule for earnings, and the age 59.5 rule, and the definition of a qualified distribution. And there's also a separate 5-year clock that can apply to conversions, which trips a lot of people up. Meanwhile, traditional IRA withdrawals are generally taxable as ordinary income, and if you take money out before age 59.5, you may owe an additional 10% penalty unless an exception applies. So the Roth tends to be more flexible, but it's not anything goes. And traditional tends to be less flexible, but it's still accessible, with taxes and possible penalties. Next, what's a backdoor Roth and what's the catch? Quick explanation. A backdoor Roth is a strategy people use when their income is too high for direct Roth contributions. They make a non-deductible contribution to a traditional IRA, then convert it to a Roth. The catch is the pro-rata rule. If you already have pre-tax money sitting in traditional SEP or simple IRAs, the conversion can become partially taxable, even if you only intended to convert the after-tax contribution. This is one of the most common, I thought it was tax-free mistakes. So if you're going to talk about backdoor Roths, you have to at least mention the pro-rata issue because it changes the tax result. Now, what are the biggest mistakes people make with these accounts? Here are the biggest ones I see again and again. Mistake 1. Contributing to a Roth when your income is over the limit and not fixing the excess contribution correctly. Mistake 2. Assuming a traditional IRA is deductible, then being surprised at tax time when it wasn't. Mistake 3. Making non-deductible traditional contributions and not tracking basis, which is how double taxation happens. Mistake 4. Attempting a backdoor Roth without understanding the pro-rata rule, especially when old rollover IRAs exist. Mistake 5. Misunderstanding the Roth 5-year rules, especially the difference between the 5-year rule for earnings and the 5-year clock that can apply to conversions. Mistake 6. Withdrawing early and being shocked by penalties and taxes. Mistake 7. Forgetting that an IRA is just an account wrapper, not an investment. People open the account, fund it, and leave it in cash. And mistake 8. which people almost never think about until it's too late. Not updating beneficiaries and not understanding how inheritance rules actually work. Which brings us to the last big question. How are traditional and Roth IRAs treated when you inherit them? This matters because the Secure Act changed the inheritance landscape. In general, many non-spouse beneficiaries now have to empty an inherited IRA within 10 years. That doesn't always mean you must withdraw every single year, but it does mean the account has to be fully distributed by the deadline. And here's the major difference. If you inherit a traditional IRA, withdrawals are typically taxable income to the beneficiary. So if someone inherits a large traditional IRA during their peak earning years, that forced 10-year distribution window can push them into higher tax brackets. If you inherit a Roth IRA, qualified distributions are typically tax-free to the beneficiary, which is obviously nice, but the account may still have to be distributed within the required time frame, and the Roth also has its own 5-year requirements that can affect whether earnings are tax-free, depending on how long the original owner had the Roth open. And spouses have extra options that non-spouse beneficiaries don't. A surviving spouse may be able to treat the IRA as their own, which can change the distribution timeline and the RMD schedule. Non-spouse beneficiaries generally can't just roll it into their own IRA. They usually need an inherited IRA with the beneficiary title, and then they follow inherited distribution rules. Now, one more inheritance detail that is becoming a bigger deal. Under the final RMD regulations, in some situations, beneficiaries under the 10-year rule also have to take annual distributions during the 10-year window, particularly when the original account owner died after beginning RMDs. So inheritance planning is no longer just, I'll leave them an IRA and they'll stretch it forever. For many people, that stretch is gone. And whether you leave traditional or Roth can meaningfully change the tax experience for whoever inherits it. So here's the practical wrap-up framework I want you to remember. Don't ask which one is best. Ask which tax timing is best for me right now, and how much flexibility do I want later. If you want a potential deduction today and you expect lower taxable income later, traditional may make sense assuming you qualify for the deduction. If you expect higher taxes later, or you want more tax-free flexibility in retirement, Roth may make sense assuming you qualify to contribute. And for a lot of households, the smartest move is some of both, because tax diversification is real. And finally, don't ignore inheritance. The rules are different now, and the account type you choose can create either a tax gift or a tax problem for whoever comes after you. If this helped you learn something new about traditional versus Roth IRAs, please like the video. It really helps out the channel. Subscribe to Built Not Lucky Finance for more financial videos, and share this with someone who's still stuck on the question, which one is better? And drop a comment. Team Roth, Team Traditional, or Team Both? And tell me the reason in one sentence.